It's our pleasure now to welcome Damien Klassen, the head of investment at Nucleus Wealth, and he's joining us from across the world. In fact, it's early morning in Australia. Thanks for getting up and being with us today.
Thanks for having me on, Kevin.
It's great to have you. Well, let's dive right into it and learn a little bit about yourself and how you came about getting into the finance business. Why don't you tell us what you studied at university and how you proceeded from there into the finance world?
Yeah, sure. Look, I did an honours degree in finance and maths at University of Technology, Sydney. So very much a sort of a quant heavy course. I then progressed. I actually started working with a stockbroker while I was at university in the research department, and then sort of moved from there into a number of different brokers. I helped start a founder firm, an independent research firm, in just before the tech boom, and so saw that, and pretty not long after we started, we saw the tech boom crash as well. And then managed to make that through and sold that firm and sort of left that just before the financial crisis.
Right, so it's some good timing. Actually, Damien, I just want to interrupt if you don't mind. You said that you got your job while you were actually going to university. That's also, I did the same. I actually ended up getting my job and then rearranging it, so I went to university at night while I worked. How did you go about getting that job, and what did you do while you were going to university?
Yeah, look. Pretty much luck in the end. It was that they were advertising for I think the company, which was BZW, a large UK firm. They brought on university students to sort of teach them the ropes and let them sort of transition through. And then and at the time, I think there was a lot of it was a lot of programming heavy, so the course I was doing was quite good for that, because it was all about a lot of it was about doing the financial modelling and automating it and getting the numbers out to various clients. And so I tended to work about 20 hours a week while I was doing it. But I think what really helped for me was the fact that as I was doing it, you got to see the parts where you'd go to courses and you'd be like, never heard of that used at work. I don't really need that as much. And then you'd sit in other courses and you're like, wow, everyone talks about this all the time. I really do need to listen to this part and dig into it.
Right. Well, that's interesting. And one of the things that actually fascinating is it sounds like BZW is actually a little bit ahead in terms of the kind of their computerization and focusing on that quant. Were they a firm that kind of embraced technology early?
Not a little bit. I think it was probably more that they wanted to get some young people into because that was sort of start of the internet. It was probably pre-internet when I first started, and then sort of started the internet, and so a lot of it was all about that transition, and they were just trying to find where do we find the next generation of stockbrokers from and research analysts from.
So you made your own firm, which you sold with good timing, right before the crash. Then you went on and actually worked for a hedge fund or actually a large fund. Why don't you tell us a little bit about the next stage of your life?
Yeah, sure. Then I worked for Schroders, which is it's about 60 billion Australian dollars, and so that was in their global quantitative fund. And a lot of what I was doing there was a lot of the resources side. How do we actually look at resources companies from a quantitative perspective? Because they're very, very different to normal companies. And so sort of digging in and trying to work out, how do you quantitatively rate a resources company, and so a lot of that was sort of sitting in where does it sit on the supply curve, and really digging into the trying to get the fundamentals the way a fundamental analyst would look at a stock and match that up with the way quantitative analysts look. So spent a lot of time at that. Spent a lot of time at energy as well. And then doing some of the big data, and I've sort of always had a bit of a passion for financials, and actually, I have this view about quant analysis that it's great at throwing up some of the questions, but it's not great at providing all the answers. And so a lot of times it's telling you where to look, but often it's giving you the wrong signals. And so really being able to dig into the financials and actually know what's going on and understand what's going on in the financials is really important. And right now there's some really big changes happening in terms of the way companies report for some of their liabilities. And if you're looking some of the old quant signals are just going to be completely wrong. But because a lot of quant analysts a lot of the pure quant people don't really understand what they're looking at, you find that they're not picking up on these signals as fast as they should.
Right, because there's changes. Why don't you give us an example of something that's changed that way, and that something that someone with a little more fundamental markets background would understand, but the quants are missing?
Yeah, sure. So there is a very big change happening at the moment in terms of the way lease liabilities are accounted for, but that one's probably a little bit technical. I think there's probably an easier one, which is there's a price to book or book to price that's a very well known quantitative signal that's sort of been around for and it's written up in all the sort of the major quant factors as terms of something you should be following. From
Right.
my view, book to price has been changing over the last 20 odd years. Accounting standards have very much changed. It used to be that once you'd put an asset onto your balance sheet, you could then write it down and then write it back up again when you thought things had got better. So whereas now, for the last 20 odd years, as the accounting standards have changed, there's now this real bias in terms of assets can be written down, but it's very hard to write them back up again. And there's actually a lot more focus on writing down assets quickly. And so what that means is that equity part of your balance sheet can shrink, but it's much harder to make it grow the way it used to. And so what that means is that number is being distorted. And you look at, there's companies like IBM is a great example, where if you're looking at say return on equity of the company, how much profit does it make for every dollar that it invests? As it's switched from being a manufacturing company to a services company, its return on equity just shot through the roof, up to sort of 70, 80% return on equity. Now, as a fundamental analyst, I know that they're not investing $1 tomorrow and getting back another 80 cents the year later. Like, I know it's just not happening, because you can dig into the numbers and see. But that's what it looks like from a pure, if you're just looking at the return on equity calculation, because they keep shrinking that bottom and doing buybacks and returning capital. So when you return capital, you often put the capital in at $1, and then 20 years later you're buying back at $20. So it's again shrinking that lower part of your balance sheet, and so that's being missed, I think, by if you're just a pure quant looking at these signals, going, yeah, this has worked for 50 years. You're saying yes, but the accounting standards from 50 years ago aren't the same as the accounting standards from today.
And is that a global phenomenon?
Absolutely.
Yep.
Yeah,
so the accounting standards everywhere, they kind of move together, and that's like it's a direction that all accounting is headed towards, in terms of this bias of not allowing companies to write assets up, and kind of a willingness to write stuff down as soon as possible.
Yes, that's right. There are different standards. Mainly, look, the US standards are different to most of the rest of the world, and most of the rest of the world works on accounting standards that are very similar. There's some slight regional differences, but I guess broadly they do tend to talk to each other. And this next change coming through about how to account for lease liabilities is being done both in the US and internationally. And so there's some big changes happening into the way companies report about how much debt they actually have. What it's trying to do is it's basically saying, well, if you've got and we could probably spend a whole podcast on this. I don't think your listeners would really appreciate it, but basically what it's trying to do is
like a CFA level 2 accounting exam, is it?
Yeah. I mean, the basics is, if you said, we're both running the same companies, I've decided to lease my properties and you've decided to buy your properties. What it's trying to do is match it up and saying, well, if I'm leasing my properties and I've got like a 10-year lease on this, I actually have a liability going into the future to pay for that lease. And so there's some part truths into that, but then it's sort of treating that as a debt sitting on my balance sheet. And so you need to work out which ratios need to have that in there and which ones you need to strip it out. And so, yeah.
So do you think that on the whole, that the whole kind of trend towards quant investing is being overplayed, and that more and more you're going to need to be successful in quant investing is going to have that human element where you really look at the underlying fundamentals and think about what the numbers mean, as opposed to just being able to run it through your model and spit out kind of instant buys?
Yeah, I think it's probably bifurcating into two camps. Is you've got your high frequency ones where you're basically saying, well, if I'm just going to take a bet on whatever. I'm reading sentiment, or I'm reading, trying to automatically scan and read things and pick up particular words. It's a little bit of an arms race in terms of going, well, if I'm getting 51 or 52% of them are right, and I'm just making this bet a lot, then great. I think I can make some money out of that. And then on the longer term side, the longer term quants who are looking at saying, well, how do I find the right stocks to buy to stick in a portfolio? I think for those ones, it is about saying, about getting smarter about how you're using it, and not just saying, I'll run the pure numbers. And actually, I've got a slide up, slide 2 of.
Okay, let's have a look at that.
Yeah, this just shows how I run my stock picking, and what we do is we run a quality axis and a value axis, and so we've sort of got cheap stocks in the bottom left and good quality stocks. So there's like a green triangle there, and so that's where we're trying to buy stocks. So we're saying, and so the idea is if we can get both quality and value, then fantastic. But the reality is, quant throws up a lot of value traps in that. Like stocks that look like they're great quality and they're great value tend to be stocks. Often they're cyclical stocks at the peak of their cycle, so just about before they're going to come down, and everyone's looking at them saying, it might be a semiconductor stock, and they're sitting at the peak earnings, and everyone's looking, going, yeah, but they go from earning that to earning zero over the next few years, and then back to earning X dollars per share. And so when it's trading on the peak earnings, you don't want to be paying full price for it. And so
right. Do you think we're there actually on the, speaking of semiconductor stocks? Do you use that example because that's something that you're looking at, or are you just worried about that possibility?
That was true maybe a year ago, 18 months ago. You'd find that you could buy semiconductor stocks for PE ratios of 4 and 5 times, and it was because they were priced on peak earnings. I think the key thing for semis at the moment is China and coronavirus. And so if you think the economy is going to sail on and there's another leg up, then it's probably they're reasonable priced, and there's probably a scope there. If you're worried about the coronavirus and the fact that large shutdowns in China are going to probably cause some economic harm, then I think it's probably too late for that trade, and it's wait for the next upcycle.
Well, speaking of China, let's and you brought up your presentation. Why don't we move to this presentation, and then we'll talk about where we head after that. But why don't you walk us through what you're looking for? You're obviously in Australia, very sensitive to China. It's obvious it's something that affects your economy greatly. Why don't you kind of take us through what you're seeing in the investment world and how you're thinking about your investments going forward?
Yeah, sure. So what I've done, I've labelled this Australia a land of contradictions, and popped up a picture on the front slide just before of the platypus and things like that. And because there are a lot of things that work very differently in Australia, whether it's the animals, whether it's the your water in the drain going the opposite direction, but economically, I think as well, there's some misconceptions. So
well, I was going to laugh because Australia, isn't it the land where you have the most animals that can kill you?
That's right.
And then you have more animals that can kill you there than like all the rest of the world combined. It's crazy that way. Anyway, sorry, I didn't mean to interrupt. Continue on.
No, that's fine. There's so one of the key things, and jumping to slide 3, so there's a lot of talk about this 28 years with no recession in Australia, and it's true. We've been through, technically, by the numbers, and so what I'm doing is I'm contrasting as I'm going through, saying so there's one thing that says 28 years with no recession. The other side of this, though, is we've actually had 7 years of no actual per capita income growth. And so it's a very different look between saying, well, isn't this a fantastic economy? Surely everyone should be trying to replicate it. And on the other side saying, just a minute, how come none of the individuals the median individual in the economy isn't actually doing very well? And so I just wanted to talk through that, how did we get to 28 years? Because some of it's good management, and some of it, quite frankly, is luck. And so knowing how we got there is important to try to work out what are some of these contradictions and what's going to work in Australia going forward. So Australia dodged a few crises. I think the 1997 Asian crisis hit a lot of our neighbours quite hard. But then the Australian dollar fell sort of 25%-ish, and we had this export boom that sort of really saved us from recession there. That rolled into the 2000 tech boom. Australia really didn't participate as much as everyone else, and again the currency fell again. So net sort of over about 4 or 5 years, the currency was down about 40%, and that really sort of saved. That was a great cushion in terms of saving Australia from recession in that time period. Then it rolled into this sort of mid 2000s and this China boom, and the important thing with China is it went from being China's actually a very big producer of both coal and iron ore, and it's actually got the most coal of anyone out there. But it went from being a net exporter of these to a net importer, and a big net importer. And so what that sort of really drove that Australian economy as all of a sudden one of your biggest competitors in this market went to actually being one of your biggest customers, or actually the biggest customer around.
Right.
And so that really drove those commodity prices. We had some major gas discoveries, both offshore and coal seam gas, and Australia's now moved to and I've got a few slides later sort of showing we've now moved to being the world's largest supplier of LNG. So, that part obviously wasn't sort of managed from internally. That was sort of that luck part. And then you get that 2008, the financial crisis. We had this energy boom, we had this capex boom going on as the crisis hit, and for a lot of it, these companies had already committed to spending billions and billions of dollars to build these mines or oil wells, and so so that kept on going because they were pot committed already, and so that sort of helped sort of get us through that. There was some quick stimulus, and I'm going to jump onto some of the next slides to show you some of the other things that sort of saved us. So
there's also China stimulating hard also helped, right?
Absolutely.
Right. That was a big function of the 08. The response from China was important in terms of helping. You were probably the biggest beneficiary of that apart from China itself.
Yeah, absolutely. And so, I often quip to people that, we were very much that China spend was exactly the ones, that what you really needed to do if you wanted to get through the financial crisis without without going into recession was you needed to have lots of iron ore and you needed to be closer to China than Brazil, both of which Australia had, and they're not really replicable or something that we can. Well, that politicians
it's not a good business plan.
No, that's right. So next slide 4, I've just got a per capita income, just showing we're actually the worst in terms of per capita over the last sort of 7 years. But then you jump to slide 5, and this is another thing that saved us from recession during the financial crisis was this huge increase in population. So we sort of ran from about 200,000 odd new people every year, or more like 80 to 100,000 immigrants coming in, to sort of 320,000 at the peak of that financial crisis. So we joke it's called quantitative peopling. You guys are having quantitative easing, bringing in all this money. We were having quantitative peopling, bring all these people in, and it juices your stats. So it means that your GDP goes up because you've got more people in here. Right. And the problem
is a great line. That is a terrific line, Damien. I love that.
The problem is politicians worked it out, and so they've now said, okay, why don't we just keep running more people? And so we're sort of running at sort of twice the annual population growth that we have had in prior periods. And so a lot of the GDP growth is just because we've got more people coming in, and way more people coming in than what we used to have. And we're certainly at the top of the developed markets in terms of the amount of people coming through. So you take that out, and you get on a per capita basis, you get more recessions as you go through. If you ignored that, the next thing that helped was this mining boom. So I've got on slide 6, I've got mining capex as a percentage of GDP for Australia, and you can see that it sort of ran for from 1987 to 2000s. It ran at roughly 1%, and sometimes it'd go well and it'd get up to 2%. And we sort of hit 7 or 8% in the following that 2007. So there was a big run up in the sort of 2000s, but a lot of that though was people still saying, "Oh, this will never last." That's the way resources booms always happen. The prices are low, nobody invests. demand starts to pick up. People say, "Oh, this will never last." Prices get higher and higher. Everyone says, "No, this will revert back to normal." And then all of a sudden, people flip and go, "Just a minute, this is going to last forever." And then everyone jumps in and starts building as much as they can. And some of these projects were there was a single gas in Western Australia that was 5% of Australia's GDP over a course
Come on,
number of
really?
years.
A single project with 5%?
A single project, 5% of GDP. It was spaced over a number of years. Like it took them 5 or 7 years or something like that to make it. But that was just one project, and there's a bunch of them out there. And so that was what really drove that next leg of growth in Australia. And as you can see, though, that's come off. Like now, those projects are sort of finishing up and having been built. And the problem was, because they all did them at the same time, it meant that wages went through the roof. So if you were a manufacturer in Australia, you lost most of your employees because they could go out and drive a truck in the Pilbara for 100,000, 150,000 Australian dollars, and so you just couldn't keep them. And that was sort of what drove that whole pushed the Australian dollar up. The Reserve Bank basically let it go. They had the view they were actually really good at calling China early about how big it was going to be, and then they sort of fell in love with their own forecasts and were talking about this 30-year boom that was going to go on forever. And so they let the Australian dollar sort of run up, sort of doubled in price versus the US dollar, and that sent all our manufacturers broke, which meant sort of hollowed out the economy. But they sort of had the view that that's fine because China's going to keep growing.
China's going to be there buying your commodities forever.
Yeah, that's right. So so we're in this funny position where we've hollowed out. The mining boom's come off, but we haven't quite come down the other side. And the reason why is because on page 7, what we did was once that first part came off, is then we inflated the housing boom. So we never really had a huge boom in 2007, and when everyone else was, we had a bit, but it was never the same size as what you saw elsewhere. And the reason why was because all our truck drivers and all our construction workers were all busy trying to build mines and oil wells and things like that. And so it was a deliberate ploy of lower interest rates, and we'll get this housing boom going, and we did. But it's a bit of a messed up housing boom, and I'll move on to that in sort of a little bit more detail later. So that sort of saved the next part from recession. And the other thing we did on slide 8 is we really ran up our debt. So we went from the green line on this chart is Australia, and it sort of sits sort of middle of the pack in the 80s and 90s, and then post 2000 we just really ramped up that household debt. And so now I haven't shown Switzerland this for we're a little bit jealous. They're number one, but we're right up there.
Why is Switzerland so high?
Well, I think we could go into a long conversation about that, but some of it is because they're some of it there are some discussions about whether that's right, whether the numbers are right.
Oh, it's one of these accounting things that's not correct. Switzerland definitely plays by a different set of rules. Let's face it, they're the only central bank that actively buys S&Ps. Yeah. Okay,
but we like to think we're if we're not number one, we're a valiant silver medal.
Number 2. I didn't realize you were higher than us. I thought we as Canadians were higher than you, but I take solace knowing that you guys are making more of a mess of your household balance sheets than us.
Yeah. So I guess in the end, though, I guess where I'm trying to paint on that one is this dichotomy about saying a lot of people say, you hear it out of the US a lot, Australia's been through 28 years. Maybe we can just maybe we can keep going. We never need to have a recession again. And part of that's coming back to saying a lot of these are one-off tricks. We got our currency down. That was a sort of one-off trick. You've had this huge boom in debt. That's a one-off trick. You've done this huge mining boom, purely based on China. Unless China's going to come through with another leg up, that's a one-off trick. We've blown our housing boom, and got our debt up. So some of these they're just not sustainable techniques.
Right.
The other thing, what that leaves us with in terms of an economy, and that's the next slide I wanted to run through, is this page 9. We're one of the world's richest, so we're top 10 for GDP per capita, and we're actually number 2 in terms of wealth per median citizen. So you're right up there in terms of one of the world's richest, but we're actually got one of the world's dumbest economies. So the Harvard University did a ranking of economic complexity in 2007,
Yeah.
based on 2017 numbers, and I've got that up on that right hand side. And so the ones you'd expect, Japan's right at the top there, and Switzerland and South Korea, and you sort of work your way down the list. Australia's at number 93, just below Uganda and Senegal, which we think with a little bit of work.
How do they define economic complexity index? How do you think that works? Like,
well, a lot
asking. Sorry, go ahead.
Yeah, a lot of it comes to where does your GDP come from? Like, does it come from making complicated things, or does it come from digging dirt up out of the ground and selling it to people?
Oh, I get it. Okay, right, fair enough. So we as Canadians would be right up there as well.
You probably don't sit very high.
Yeah.
So
that's why Japan is so high, because they have no digging up. There's no resources there. It's all value add. Okay, I get it.
That's right. And so I've got another slide on slide 10 that sort of shows what does the MSCI Australia look like. So what do you get when you buy it? And so one of my strategist who he blogs for us under the name of Houses and Holes, with a view that that's what Australia is. We basically dig dirt up out of the ground, and then we take the money and we use it to bid up each other's house prices. And so it's just it would be funnier if it wasn't as true, I suppose.
That's right. It's hitting a little too close to home for you.
That's right. And so what I've done is just said, well, the houses part that's a lot of our banking. In that blue bit, I've put in the houses, I've put a lot of our banking, and then all the companies that are involved, and there are some of the retailers that just sell the bulky household goods. So the bulk of our, whatever it is, about a third of our economy is a third of our market index is that. If you then take the holes, all the resource companies, you get well past 50%. There's international, I call them international stocks that just happen to be listed here. That'll give you another slice, and then so your actual sort of other domestic is only a little bit more than the quarter of your market. So right. If you're looking at buying the Australian market, you sort of just need to know what you're getting into. If you like the idea that things are going to keep on going, and that potentially China's they've got this another stimulus coming to try and get them through the coronavirus sort of overhang, then that's what you're going to get from Australia is these houses and holes if you're in there buying it.
Right.
I'm not a big fan of that, but we'll get to that as some of the investment stuff a little bit later on. Okay, so that's another dichotomy. One of the world's richest economies, but one of the world's dumbest. The next one's this. We're the largest commodity exporter in the world, and that's on slide 11. But with that comes this whole Dutch disease. So, and manufacturing sector is now sort of under 6% of our economy. It's halved over the last 20 odd years. On the left there, I've got Australia's exports this is 2019 data. And so it's actually a bit more surprising than I think a lot of people understand. So iron ore, which we're number one in the world in terms of an exporter, brought in about $65 billion US for us last year. Copper, which we're the third largest exporter, brought in maybe $5 billion. So it's really just an afterthought. Really, iron ore and coal are actually much bigger than most people give them credit for. I think certainly from a trader's perspective, the focus really on gold and copper, I suppose, and so some of the energy. But Australia is massive in these, and they actually make when you're looking at the companies, you're really getting BHP is a little bit different. You get mostly iron ore, but you do get some other factors. A company like Rio Tinto, you're pretty much getting iron ore. Like you're getting there's a little bit of these other factors, but they are big, very big in copper and other minerals. But where your earnings are coming from really is just iron ore.
Right.
And so the manufacturing side as well. What's so much of that's shut down in Australia. So all the car manufacturers moved out. As this mining boom happened, Australian dollar went to parity with the US. And as I said, it sort of doubled from where it was in the early 2000s. Manufacturers just moved out of the country, and they don't come back quickly. When it's not like the currency falls a bit further and everyone says, currency's back to sort of 60 something. Let's now go start up. Let's go create a new factory and buy it and build it and set it all up, those things take years and years and years. So it sort of leaves us with this sort of hollowed out economy. And then on the iron ore side, I've got another chart sort of showing the iron ore on this next slide, which is the last 5 years of the iron ore price. Now, the iron ore price has, iron ore is it's not like a brand new metal that's, we've never heard of it, but we've been producing it for thousands of years. The longer term prices are about $20 or $30 a ton. And the prices at the moment, or certainly over the last year, were closer to $100 a ton. And a lot of that was because of this Brazilian mining collapse. So it's been really a supply side. So there's pretty much, of the big exporters, Australia and Brazil make up, I think it's about 75% of all iron ore. And Brazil had this two dam collapses, one in 2015, which killed a bunch of people. Then they rushed around and checked all their dams and said, no, everything's fine, guys. It was just a one-off. It'll never happen again. And then in 2019, another dam wall collapsed, and sort of 300 people died, and there's sort of 16 people have been charged with 16 people from the company have been charged with criminal offences. They've shut down, a swathe of their production, and that's what really drove iron ore prices up. And so, which is a great beneficiary to Australia, because that's where all this royalty income comes from. And that's sort of it basically, at the last election, which was sort of mid 2019, it gave everyone a big box of money they could get out there and spend and push through to consumers. So if you
it's not
believe,
gonna last, right? Eventually, those will come back online, and the price will go back down.
That's right. They're already starting to come back on. A lot of them came back on sort of the middle of the year. Now there's more court cases, and so it's a little bit back and forth, but it will come back on. So it's sort of been for Australia, it was a very lucky episode in terms of giving you that extra push, but it's just not a sustainable advantage. The other thing is, as you spoke about before, China, and I've got a chart up here of Chinese floor space under construction. Right. Now, in 2008, the premier came out.
This is slide 13, by the way.
Slide 13, yes. Sorry.
Yep.
So in 2008, the premier came out of China and basically lamented how unbalanced their growth was, about how much of it was focused on capex and building and not enough on services and the retail sector and consumer side of it. And that was when they were building. I've circled they were building less than 3 million. 3 million of 10,000 square meters, so less than 3 million on this graph. And now we're at 9. We're sort of almost 3 times that at the moment. So part of that was that real big push. So you can obviously see between 2009 and 2014, there was that really big push in China to get out and spend a lot of money to get them through the financial crisis, and that was Australia was a huge beneficiary of it. But there's actually been another push in 2019, and there's a question about how much more can you build. So
So I didn't realize this. China basically looks like they've broken out in terms of already going back to the infrastructure, kind of residential or floor space. 19 was a breakout year versus the last kind of 4 or 5 years.
Absolutely. And so the question is, how much higher can you go? They're already outspending what they can. And it's got to the stage now where what they're doing is there's actually fewer people moving into cities now than what there was 10 years ago. So 10 years ago, they had about 25 million people moving into cities, so urbanizing, and now it's back to about 20, so that's sort of tailing off, and expected to keep tailing off. So what a lot of it is now is actually knocking stuff down to put new stuff up.
And why do you think they did that? What was the reasoning behind this? Kind of, it almost looks like a desperate increase. And one of the things I worry about is that as we go through this flu virus problem, I was expecting this to come going forward. But now I'm looking at it and thinking, oh, geez, they've already started it. And that's kind of worrisome. What was the reasoning behind this kind of push?
Keeping people employed, I think, is a large part for me. I mean, I think that they would love to transition their economy away from the capex and away from the
Right.
and to a more consumer centric, but they know this is the lever that works. And so I think they try and transition it away. There's lots of vested interest. I mean, there's so much money has been made in China from all this development that I think from a party perspective, they need to keep all these people happy that are working in that industry and making money from that industry. There are a lot of very pious Chinese public servants that own hundreds of apartments and have made a fortune from it. So I think there's that whole part about if you want to maintain power, you need to keep those people happy, and so you need to keep spending.
Right.
And in a way, we liken it a little bit to the Soviets when they at the tail end of their economy is that they had this planned economy and everything seemed to be going quite well, but then they were just pumping as much as they could into this whole producing weapons, for no real economic purpose. And what we worry is that this isn't for a great economic purpose. If you're knocking down one 20-story building to stick up a 25-story building, there's not a lot of economic gain in that. It keeps a lot of people busy and employed, but there's not a lot of real genuine.
Right. It's the old digging ditches to fill them in.
Absolutely, and it's all debt funded as well. Like more and more of it back, the stuff back in early 2000s was debt funded to a certain extent, but it made its money back very quickly. Whereas now the debt in China is growing so quickly just to build more buildings.
Right.
So
that's interesting.
So we're quite concerned about it. When will it finish? We don't know. People have been calling the end of this since 2009.
Right.
But it's obviously unproductive and needing more and more debt. And so, will you find something like a coronavirus? Can that knock it off and actually cause some of this debt to be called in? I don't know. It depends on how much the central authorities, how much control they have, and how much they think they want to keep pushing this in terms of is this how they keep the population employed and happy?
Right.
The other thing coming up for Australia, though, as well on this side is that there's recycling of steel is very important. So in the US, for example, about 90% of steel gets recycled. So you don't actually have to dig up all that iron ore. In China, it's more like 20%, but it's growing fast. And so even though they've been using more and more, on the flip side, they've actually been recycling more and more. So it's when you start coming down the other end of this, that the worry for Australia is when this starts to fade away, is that'll probably coincide with when recycling's picking up, and so the demand for iron ore could dramatically drop at that point.
Right.
So next contradiction is on slide 14 is Australia's now the largest LNG exporter in the world. Overtook Qatar in 2019. I think Qatar still beats us some months, but over the course of 2019, Australia was exported more. And so you can see on the left-hand side of this graph, about 2015 was when all these projects really kicked in, and that took off. Then you can see on the right-hand side Sydney gas prices. So, and this is the wholesale prices. So what manufacturers have to deal with, and you can see in that in 2015 gas prices really took off. So basically, as all this gas came online, our gas prices more than doubled. So
that's amazing, because that's the opposite of what's happened here. We've had a situation where they found tons and it just keeps going lower and lower to the point where we're going to be just kind of closing and shuttering these wells because we can't make any money doing gas. And yours was you guys found all this and you figured out a way to sell it to China. And it's unfortunately, though, it's causing your local industry to have to pay much more.
Absolutely. So we got done over basically in Western Australia, which is another big exporter of gas. They put on domestic reservations, same as US had, same as most countries have. They say, okay, you dig up this gas, certain percentage of it has to be available for locals, and that keeps your local gas price high.
Right.
The politicians were convinced by all these major internationals that were going to invest all this money, and you saw the amounts of money that were invested. As I said, one company alone, Chevron, stuck 5% of Australia's GDP into building this thing. They convinced them that no, there's so much gas here, you don't have to worry about it. And then once they started, they went, well, we don't have to we don't have to dig up all that extra gas. We can just sell it, and we can we can sell to locals for the same price as what we're selling to people overseas, then we'll do it.
Right.
Um,
That's
the
shocking.
other
The company looked after its own interest and didn't take care of the locals.
No, that's right. Well, what was shocking was, I mean, companies you expect are going to do that. You want your
Right.
politicians to stand up to it, but unfortunately, both
Okay.
sides were involved, and so
Oh.
nobody talks about it. It's just that's just the way it is, But the other thing that you'd say, so that's a blow for manufacturing sector. The other thing is though, you'd expect to get royalties from these. So the companies also managed to convince the Australian government to set up this new royalty regime where the higher the price went, all of a sudden the Australian government started making it like bandits. So when the oil price was over $100, all this money was going to come flowing into the Australian economy. But when the oil price fell, all the royalties disappeared. So you can see Australia and Qatar roughly the same. Qatar makes about $26 billion a year from royalties. Last year, Australia made one.
Oh,
So,
you're getting played. You're getting played by the companies,
absolutely.
right?
And the companies aren't expecting to pay until the mid 2030s.
Oh my goodness.
We on top of that, because they spent so much money, they've got these huge tax losses. So tax credits. So the amount of money that Chevron and Shell and ExxonMobil, the amount they have in tax credits is equivalent to about 20% of GDP. So there was a report out last year. There's this one built in Darwin. This is actually, I think, by Ixus, which I think is actually a Japanese one. So they're going to export about $195 billion in LNG over the next 20 years. They're expecting to pay no royalty at all over that time period.
Goodness.
They've got all these write-downs. So the irony is, the higher the gas price goes, the worse it is for most of Australia. So we've had we sort of basically front loaded. We got all this great capex that sort of drove prices higher, drove wages higher for a short period of time, and spent all this money on capex, which is now all finished. And every time the LNG price goes up, manufacturers in Australia suffer more, and all the money goes to generally. I mean, some of it goes to local companies, but most of it goes to offshore companies.
Right. Understood.
So, yeah, like and the scary thing is they're actually talking about putting import terminals in. So there's some of we're talking about there's gas molecules that start in Bass Strait, which is right at the bottom of Australia. They're talking about basically shipping that gas up to Queensland, which is about the same distance as New York to Miami. And they're talking, it's the same as if Miami had all this gas. They ship the gas from Miami up to New York, freeze it and send it out somewhere, and then turn the boat around and bring it back down to Miami and bring it back in as an import terminal.
God.
So
only politicians.
No, that's right. So hopefully that won't get up. But yeah, it's this huge contradiction in terms of how can you be the biggest LNG exporter and basically making it worse for your own citizens. And our energy prices have gone up as well. So this is I'm just talking about companies. Individuals have had the same problem.
Right.
The next one is I've put it as two sides. So both of them we're a large China trade partner. So this is on slide 15, and that's the positive side, and the negative side is we're a large Chinese trade partner. So we've got international students per 100,000 of population. We're like streets ahead of anyone else.
Holy smokes, you really are.
With the
that's crazy. Like you're like double. Like I thought we were high as Canadians. And you are, because we're just higher than the Americans, but actually America's quite low. Oh, wow.
Yeah. So
Canada is like 550, and you guys are 1,600 almost. And the United States is 250.
And right now, they're not allowed in the country. So our university year is just about to start, and international students are still under the whole travel bans for coming from China. Coronavirus.
Right.
So,
that's not going to be, and it's not going to be solved in a week. Like that's not going to be lifted tomorrow or any, that could be months.
That's right. So there could be a big fallout from that. So when we're talking hundreds of thousands of students, and they all obviously need somewhere to live, and most of them live in inner city apartments, and they eat a lot, and there's a lot of there's a lot of businesses sort of set up around servicing international students, let alone the money just for the universities get. The Australian universities have very much built this whole business around servicing international students. I mean, there are there's a number of universities where I think there are over 60% now international students compared to 60% international students and 40% Australian students. So it's all been based around the Chinese, bring Chinese students in and Indian and other countries. But Australia is very dependent upon China for that.
Right.
The other thing we're very dependent on them for is for tourists. So tourists are very much, they're sort of basically double the other. That's the graph on the right. And again, they're not allowed in the country without a 2-week quarantine. So if you're going for a short holiday, the last thing you want to do is go somewhere where you're going to have a 2-week quarantine before you can get in. So Australia very dependent upon for two of the biggest industries, X resources, and obviously the coronavirus is going to cause big issues for both of those. The next one, slide 16. Our central bank has so we've got this high inflation target. So Australia actually targets between 2 and 3% on average. So generally we like to run our inflation quite hot. The flip side is the central bank's very optimistic, and has been optimistic for the last 5 years. They've missed their target. They haven't been within the band. They think they're going to get back there within the next 2 or 3 years. But on the right, I've got a chart of this is what their wage index forecasts have been all the way down. They keep thinking that wages are going to come back to normal, but they're sort of not factoring in the high levels of debt and the amount of reliance we have on these on resources and other factors that just aren't there. So
and has your central bank done much like the Federal Reserve has done recently, where they said because we've been under target for a while, we're going to let it run hotter on the other side to get the average over a longer term period to equal our target? So I see that you basically have had 4 years where it's been under 2. And if your target is 2 to 3, does that mean that you're going to get a situation where ideally they would like 4 years at above 3? Yes,
that's right. Okay. Having said that, I think they're a little bit fixated at the moment on this whole animal spirits thing. I think they seem to be I don't know, my reading of the tea leaves is that they think that it's just animal spirits. If we can just fix the animal spirits, then everything will be fine. And so what tends to happen is they'll cut rates a little bit, but then they'll say, well, we think this will fix everything, and people's animal spirits will come up, and then we'll have to worry about raising rates. And then so they've been very reluctant to cut rates for the last 5 or 6 years, but they've just had the market's just forced them to do it every single step of the way.
I think the reason because of that is because they don't understand that you are now in a balance sheet recession. Up until this point, you guys weren't. You were probably the last country that wasn't in a balance sheet recession. So therefore, you were still, the consumer was sensitive to interest rate changes. But now that they're no longer, I think that they're going to join the rest of the world in seeing that monetary policy is way less effective than they ever imagined.
Yes, and you'd like to think that because we're the last one, we've seen what everyone else has done, and we can just say, oh, well, we know what works and doesn't work. But
well, you would think that, but most central banks still haven't accepted that. It's taken a long time for people to realize that central banks are ineffective in terms of stimulating growth, and that it has to be done on the fiscal side. But anyways, that's a topic for another discussion.
That's right. Yes. Now, I tried to come up with two sides to the housing boom side, but I just wanted to. I couldn't. So I just titled the next one "Bizarre Housing Boom." So this is on slide 17. It's been crazy. So traditional. I just want to go through a traditional credit-driven house price boom, and I've sort of got the 7 steps here. You get this increase in credit and a loosening up of lending standards, and house prices start to go up, and that means building starts. And so you get this lag. Everyone starts building. Demand's still greater than supply, so you see prices start rising even further. Central banks start jumping in and raising interest rates, trying to slow things down, but construction's still strong. Your prices stop rising, all this supply hits, people have hit their borrowing capacity, and now then you start seeing prices fall. But as prices are falling, all that supply, because construction is lagged, starts hitting the market, and then you get prices falling, interest rates falling, and then you reach the bottom and off you go again. And so that's a relatively typical credit price cycle. So we've got a bizarre one at the moment. So I'm going to exclude Western Australia because they've actually had house price falling right throughout this with the same sort of monetary settings. But along the East Coast, there's been this huge boom in apartments. And so what that means is there's a much longer lead time. So whereas building a house, maybe 6 months to a year, a lot of these apartments might take 2 or 3 years. So we've started building all these apartments, and we've got house prices booming away, and credit is just free and flowing as fast as it possibly can. Then we had this what's called a Royal Commission. So we actually had our judicial system looking at issues with the banking sector, and they basically came out and said, you can't lend to people if they can't afford to pay it, and that's what you guys are doing, and that's criminal behaviour. And so all of a sudden the banks stopped, not because the legislation or anything had changed, but because they were looking at it going, yeah, they're right. We have been lending to people we shouldn't be lending to. They basically, what they were doing was they had a poverty measure of income, and so of expenses, and they basically said, well, if we'll apply that to pretty much everyone. So if you turn up with a private school fees and a BMW lease to pay for, and your country club memberships, they would look at your expenses and say, well, we'll pretend you're on the poverty measure, and then we'll lend you as much as we possibly can above that, despite the fact we know you have all these other expenses. And so what that meant was this obviously a huge boom in credit. But then we had the Royal Commission saying, well, you can't do that. And so we basically jumped before we didn't even need to raise interest rates. We actually jumped to this credit contraction. So say we jumped from sort of Section 2 to Section 6. And we still hadn't had the major job losses, and we still haven't actually had the major, because the apartments are still lagged and still haven't sort of they're only just being finished. And then we had this a government come in and say that they actually wanted to get the whole housing boom going again. One of their promises was that house prices will be higher under us than what they will under the opposition, and so they're exhorting governments people to lend. And so they've actually sort of blasted us back to stage one, effectively, before we've been through this. So it's very hard to know where we are. And then you've got the coronavirus. So let's just exclude the coronavirus. But we're back into this whole, the construction's coming off on one side. We've got this huge supply coming through. They're trying to force credits down everyone's throat. It is a very weird place to be. And the coronavirus and that slowdown could easily be enough to sort of tip us back into sort of Section 6. But it's just hard to know where it's going. And on the next slide, it sort of had the government sort of 4-stage plan. So I guess this is our sort of ironic look at what they're really, well, we spoke about having the second most indebted consumer in the world and saying we want to try and get these guys to borrow more. So they've sort of got a bit of a 4-stage plan, as we call it. The first one is first home buyers. So when everyone's geared up to their eyeballs, the only people that aren't are first home buyers because they haven't got a house yet. So we're now going to lend them, and the government's going to back lending those guys up to 75% up to 95% of the value of their home. So we need more debt in the system. Pressure on regulators. So all the regulators got taken to task by this Royal Commission. 4 days after the government was elected, one of the regulators that was taken to task was loosened credit conditions. Basically said, banks could go back to calculating this themselves. We don't need to put limits on banks. The head was reappointed for another 5 years. So the guy who oversaw all the problems was given another 5 years. And it really looks as if we see housing booms occur when regulators are asleep at the wheel, but this looks like a housing boom where the government's sort of pushing the regulator to say, can you loosen up credit conditions any further?
Crazy,
the government,
isn't it? Yeah,
I know.
It's like they're actively encouraging it.
Yes, well, and the Prime Minister used to work for a housing industry association. Like his job was to lobby. He was basically a government lobbyist for the housing industry. So he's got close ties. For him, it's just
I'm actually surprised that this hasn't been done by Trump in the United States, given that he was in real estate.
Yeah, well, hopefully he's not a listener to yours, and he gets some ideas.
I don't think he is a listener.
The next stage is they've withheld. So they've been very surplus focused. So the government had this whole thing about we're going to deliver a surplus, and we're not going to spend money. And part of that is that puts all the focus back on the central bank to keep lowering interest rates and get the which then makes it easier for people to borrow more money. And so the idea is they borrow more money, then house prices go up. They've sort of abandoned that surplus. They've abandoned the target because they know they're not going to get it, because after the wildfires and the coronavirus, they know they're not going to get there. But there is still they're not out actively spending. There's no fiscal push at the moment. And the final stage is, if your existing citizens have too much debt, what you need is new citizens. So we're bringing in as many people as we can. Like the forecasts, as we spoke about those, our quantitative peopling plan. There's the government forecasts have way more people coming in, and that's where you get these concerns in, where it's a bit like you've got all these people and you keep telling them, hey, you've never had things better. Look at 28 years of unbroken GDP growth. And all these people are looking at their own pay packets going, well, just a minute, my pay packet hasn't gone anywhere. And on top of that, we're crush loading our cities because it's very hard to bring in this many people, and without having bigger wait times and bigger queues at hospitals and public transport and all that type of stuff. Which is why we then start going through. We've been through 7 prime ministers in the last dozen years, so people know there's something wrong. They don't know what it is, but they know that you can't have governments trying to tell you how good things are when you're looking at their own pay packet and not seeing it. Some more contradictions, page 19. I might leave most of those because we're probably getting close on time. I will talk about that last one though. So we're 1 or 2 in terms of the world's largest per capita emitter of emissions, and we're one of the countries most affected by climate change. So I think there was some really big, we call them bushfires, but wildfires or forest fires in California. Burnt out about 300,000 acres last year, and so obviously hit a lot of headlines over there. The bushfires in Australia burnt out 27 million acres so far, and we're still only halfway through our bushfire season. So we are a country greatly affected by it. There is a bit of a push for more climate action on our side, but the current government is dead against it. And as you saw from those numbers we had before, coal is a massive exporter, and they're very supportive of not doing things. So
right, coal is a big portion of what you export, and there's probably nothing worse than coal.
That's
we get
right.
in trouble here for sending oil to the U.S. and they're busy trying to shut us down for that. But coal is in another league.
Absolutely, and so. So we've got this. There's lots more to come on this side. I mean, I think my analogy is we had this huge drought from 1997 to 2009. So a 12-year drought, and then that was followed by floods. That actually the floods were so huge they an area the size of France plus Germany put together was underwater in the middle of Queensland and West Australia, and New South Wales, and the global sea levels fell about a centimetre. A little bit less than a centimetre, about a third of an inch. Global sea levels fell, but there was so much water dumped in the middle of Australia at that stage. So,
wow, that is fascinating.
We know we're susceptible, and that was at that time we had a prime minister come in who he sort of rode in on the back of a whole climate change. Climate change is the greatest moral challenge of our lifetime. Before he realised that staying in power was actually his greatest moral challenge, but that's another thing. But because we had a pretty good run from then, so we had a really bad run, and then that sort of really brought climate change to the fore. Sadly, we had a great sort of the last 5 or 10 years has been pretty good in terms of rainfall and that type of stuff. Temperatures obviously keep rising, But I think that sort of really pushed it to the back of the pile in terms of people get focused on, we'd like to do stuff on climate, but we really want to get paid more and we want to have better jobs. I think the wildfires will make a difference. The amount that's been burnt and the effect it's had, and even just the effect on tourism and things like that. So, I think there is more to be done, but we're probably another government away from that.
Right. So listen, you've sketched out a great kind of overview of Australia and what's happened. What do you think are the kind of opportunities going forward for an investor? And even if it's selling your country short, tell us what you think.
Yeah, that's right. So that's it. This next one, this page 20, gives us our stock valuations versus expected growth. So, and then again, another contradiction. Australia is almost as expensive as the US, and we've got basically the lowest growth forecast of any of the major developed countries. So, and actually, it's even worse than this, because what's worse is our index is dominated by banks and resources, and they're low PE sectors. Like, they're not sectors that should trade on a high PE.
That's right. You should be lower naturally.
And so if you go sector by sector, almost every single Australian sector is more expensive than its US counterpart. And we've just got no growth. We've got an indebted consumer. So the big issue is, though, for foreign investors is the Australian dollar and this whole leverage to the Aussie dollar that you get. It supercharges your return. So if you invest in Australia and the world economy goes well, then the Australian stock market goes up because we're very focused on the resources side and the rest of it, and the Aussie dollar goes up, so you get double the benefit. The flip side is you get double the loss on the other side. Us as investors investing out, we actually counterbalance, so we get the opposite. We actually get it actually dampens. It's actually a very nice hedge for us, because if things are going poorly, the Aussie dollar falls and our stocks fall overseas. But for people thinking about investing in Australia, the one thing you do need to focus on is that leverage to the Australian dollar. If you do have a view that China's going to do this massive expenditure following the coronavirus, and they're going to ramp up spending on all these different construction mainly, then you invest in Australia, you're getting Aussie dollar going up, you're getting iron ore prices going up, and a big exposure to extra revenue for the government. It's a win-win situation.
So I'm going to put you on the spot. Do you think China is going to do that?
I think on the construction side, I don't think they can. I think they're already at maximum rates, and they could try. They can. It's incremental from here. I think, other than saying we're going to have 60% of the population working in the construction sector, I really don't think they can do too much more on that front. But I could be proven wrong. I'm not. I've been thinking they've got to start pulling back soon for years now. So,
do you think you're probably closer and follow it more than most of our North American listeners? Do you think that the virus situation is more or less dire than the market believes?
More dire, yeah.
We're
and look, part of it for us is because of all the effect on the tourism and the effect on the students and all these other factors in Australia, is we're looking at this and saying, Chinese companies can now start calling force majeure on contracts they don't like. We're just looking and going, if you've got an overgeared company with a supply chain in China, or even just lots of customers in China, or reliant on tourists, these things are going to start going bust because they just haven't got they just can't afford to pay the debt. So if they're geared up, and the question is, does that then cycle into, we're obviously at pretty high corporate debt levels. Is this an end of cycle event? I could very easily see it happening for Australia. The question: do you think
your government's going to be on top of that and get out ahead, or do you think it's going to be something that they're
no? Well, I think part of it for two reasons. One is they have been surplus obsessed, and they have complained about all the spending that the other party did during the financial crisis. So they will have to do a 180. I think if things got bad enough, they will, but I think it'll take them a little while to get there. The other thing is our Prime Minister got smashed he went on holidays in the middle of the wildfire season, and didn't tell anyone. He actually went to Hawaii. So he just got smashed for that. He's been. I've got this hashtag on slide 21, Scotty from marketing. So there's an Onion, effectively the Onion type newspaper, that tagged him as Scotty from marketing, and because he has a marketing background, everyone sort of focused on that because he's all about the spin. Like he's basically doesn't really have any real policy changes he wants to do.
Right.
It's all about spinning it right, and so our take is that he's too focused on that surplus, but because he's been smashed so badly on his humanitarian side, and just his reaction to, because he actually brought a lump of coal into Parliament to tell people how good it was, and so he's sort of
What is he, the Grinch? He's the Grinch. He's going to put it in someone's stocking.
Effectively. But so he's stuck in this position where he's got this core set of supporters, and probably similar to, there's probably a core set of oil guys in Canada that are very much the same. They want to keep the jobs, and they want to keep all that going. And climate change, we're a small part of a big economy, a big world. Somebody else will have to fix that. And so he's trying to keep those people happy. And so and he's been really hit up for that he wasn't empathetic enough to all these people who were having these problems with the bushfires, because he sort of took the view that, Australia always has bushfires, this will be fine. And then it's like, well, no, it's not fine. It is a big deal.
Right.
And so I think now what's happening with him is he needs to take it on the coronavirus. You can either take a view of saying, let's try and minimize the economic detriment and not put quarantines and travel bans and all these things on there. Or you can say, I'm going to try and save as many lives as possible, even if that means a cost to the economy. And I think he's taking that second view. I mean, we've put the same travel bans on that the US and other places have, and you saw how much that's going to affect our student trade and our tourism. Right. Like the same policies is going to have a much larger effect on our economy. And
I actually wonder, thinking this through as you tell me your situation, if that shorting Australia is a great hedge, versus long risk somewhere else. Because let's face it, it's going to take a while for this to get through, and even if it gets through, it doesn't sound like the fiscal side is going to be. There's going to be a fiscal response out of Australia.
Not a quick one.
Right, and if it ends up being that there's not quite as much, let's say, building out as I think, then you guys could really suffer. This could really be probably even apart from China itself, you would probably be the next most exposed country. Would you not agree?
Absolutely. Yep. Now I'm minimum weight Australia in every portfolio that I manage at the moment. So, I've assumed the crash position. I'm sort of peeking out between my fingers, wondering why we haven't hit yet. So yeah. So I think there's, okay. I'm certainly not on the whole, but I can see the case for it. I can see the case for saying if China does come out with a massive, massive stimulus, Australia is going to be the number one beneficiary of it.
Right.
From a resources perspective. Fair enough. You need to say, will we be letting all these other people in? And so, there's so many other issues that we're dealing with. It could get really, really bad for Australia, though, as I've sort of hopefully pointed out during this.
So listen, that was terrific. I always try to leave with something a little personal. So I was thinking about things to ask you. And why don't you give us some Australia slang that we might not know?
Oh God, Australia slang. I need to go.
Actually, do you have Australia financial slang by any chance? Because, someone asked me the other day, what was Canadian financial slang? And I said, well, on the trading desk, we used to say we filled them like a butter tart. And Americans don't seem to like butter tarts. It's a purely Canadian thing. And so they were like, oh, God, that's like the most quintessential Canadian hokey thing I've ever heard. So do you have something like that for Australia? I am putting you on the spot a little bit.
One of the guys I work with he spends all day talking about these two, and I can't think of one off the top of my head now.
So what are you mentioned you have some teenagers. What are the teenage slang that we might not know here in North America?
Look, I think teenage slang now. I think you'll find that's it's pretty global now. I mean, they don't watch any Australian TV. It's all YouTube and Instagram. So I think we're going. The next generation is going global on us. I think.
Oh, I get it. So you don't get the same one. Because I actually love it when you guys talk about the roos, like the kangaroos. You don't call them kangaroos. You use roo.
Ruse,
And
yeah,
are they
yeah.
as mean as they look here? I'll get you off the hook here.
Jump
I
into
put
those
you
ones.
give
Yeah,
you a
yeah,
tough one there, but I'll ask you something. We have raccoons and bears, and our bears are like our grizzlies are mean. Our black bears are fine; they run away, and raccoons are just kind of annoying. But these kangaroos look downright mean. And I don't know if that's kind of a stereotype that I just see the videos where one decides to like fight some guy, and I see pictures of guys that the dog they get in a fight with the guy's dog, and then the guy ends up basically punching him in the face. And this kangaroo, are they that kind of aggressive, or is this just kind of an image I've gotten incorrectly?
I think that's an image you got incorrectly. I think there are a lot of kangaroos. I think if you they're not the type of animal that would chase you down. There's
Oh, okay.
and so I think from that perspective, no, you shouldn't. They're probably not your biggest worry. I think there's I think should be more worried about the poisonous things, but most of those, you just got to worry about not stepping on. I suppose if you're ignoring them, they're usually pretty fine. But I think a lot of Australia's, especially the dangerous side of Australia's wildlife, sort of to me it sits very similar to the bears. Like if I said to you, oh, you shouldn't go hiking because the bears will get you, is very similar to people saying, oh, you shouldn't go hiking in Australia because you'll get poisoned or stung or whatever. So there's actually very, very few deaths.
Yeah, I understand that people are all scared of bears in Canada, and I'm like the black bears, especially where we live. They're basically just big raccoons. Like you can yell at them and they go away. They honestly, the grizzlies are another matter. Those big grizzlies, but they're few and far between, and they generally want to. You have to be really in the middle of nowhere. But they are in another league, and you really do need the bear spray for them. But most bears in Canada are quite fine. Anyways, Damien, it's been a pleasure having you. Why don't you tell people where they can find more about your firm and where they can contact you if they wanted to chat about all things Australia and all the different things that can kill you there?
Yeah, sure. Look, nucleuswealth.com is the best place. We've got all our social medias there. We post on LinkedIn and Instagram and Facebook and Twitter. So you can that's probably the best place to go, and you should be able to find all the links there to get in contact with us.
Great. Well, thank you very much. It was a pleasure having you, and thanks for getting up early in the morning. You're a real trooper.
No worries. Thanks a lot.
Thanks.